Japan's economy, once admired as the miracle of Asia, now seems like it's in an endless game of cat and mouse, where the mouse happens to be inflation and the Bank of Japan is the lazy cat that's slow to react. Sounds crazy? Well, hold on to your seats as we dive into the mess. Let's break this down, folks. The Bank of Japan's, BOJ, decision-making has been questionable for a while now. Domestically, inflation, the very beast they were trying to suffocate, has been persistently hovering around 2%, Japan's official target rate, for over 2 years. If you're thinking, great, mission accomplished, they got us to hit that inflation rate. Pop the champagne, well, not so fast. While inflation is finally where the BOJ wanted it, their interest rate has languished at an almost laughable 0.25%, the lowest among major developed nations. One of the nation's top economic minds, Hiroshi Yoshikawa, a former advisor to Prime Minister Abe and buddy of the BOJ Governor Ueda, gives a scathing review of the BOJ's sluggish response. He describes it bluntly: raise interest rates while you can. But it seems even with all the flashing alarms around them, the BOJ is still dithering. Imagine your house is on fire, and instead of grabbing the fire hose, you're leisurely sipping tea, waiting to see if the flames, with a bit of luck, just cool down themselves. Bad news, they won't. The real kicker here is that the flames are starting to spread. The truth is the BOJ, with its constantly low rates and quantitative easing measures, isn't just dragging its feet, it's downright stuck. Let's face it, Japan has been riding the wave of quantitative easing for far too long, and the tide is beginning to turn. Sure, it worked in the wake of the lost decade, but the economics of 2024 aren't the 90s or the early 2000s anymore. To get a sense of how Japan is falling out of sync globally, just glance at what's happening around the world. Both the United States Federal Reserve and the European Central Bank, ECB, have been aggressively hiking their interest rates since 2021. As of October 2023, the U.S. federal funds rate sits between 5.25% to 5.5%, and in the Eurozone, a whopping 4.5%. So, why does this matter? Japan is running with 0.25%, the tortoise of tortoises in this rate race. And here's why it's dangerous: when global rates rise, capital flows to the safer, higher yield markets, not Japan. This has, as expected, weakened the yen steadily. Since January 2023, the yen has depreciated almost 14% against the US dollar. Forget about taking a holiday abroad, ordinary Japanese citizens are facing sky-high import costs alongside additional inflationary pressure in their daily lives. For Yoshikawa, the writing is on the wall. Japan cannot afford another economic downturn, but here's the dilemma: if the BOJ keeps its rates low, it's running the risk of recession being triggered by lack of monetary flexibility. Yoshikawa fears that the BOJ might soon run out of juice to stimulate the economy if growth slows further. Yoshikawa's statement that, if rates are already at 0.25%, they can only be cut to zero, seems like a tragic self-fulfilling prophecy at this rate. There's simply not enough room left for the traditional tools of monetary policy. This means Japan could be sliding back toward the days of negative rates or even implementing once radical, unconventional policies just to accomplish the simplest of outcomes later down the line. Ugh, sound familiar? It's basically the economic equivalent of déjà vu. And don't think falling rates help the common people. The life savings of Japan's elderly, a demographic that makes up 28% of the population, stagnates in low-yield savings accounts, and when prices rise, their purchasing power plummets. Cheap interest rates are no longer a blessing when inflation rises faster than those rates can correct. Beyond the hesitancy rooted in institutional tradition, the interdependence of Japan and its productivity is deeply embroiled in decades of aggressive deflation-fighting policy. This is where the conversation gets trickier. The BOJ's caution stems partially from fear of revisiting historical failures of rate hikes causing premature downturns. This fear is ingrained in their DNA after the lost decades. Plus, throw in the issue of debt. Let's talk numbers. Today, outstanding public debt in Japan is well over 250% of GDP, and hiking rates too fast would explode the government's debt servicing costs. The Ministry of Finance is wary of the fiscal impact of paying more on its gargantuan debt given the extremely low revenue-to-expenditure ratio Japan currently endures. This, of course, strains the mindset of the current policymakers. But the reality is, when policymakers drag their feet on crucial decisions for long-term gain in favor of avoiding short-term pain, it increases the risk of eventually being forced into reactive, instead of proactive, strategies. The resulting economic whiplash could become a scenario that mirrors the BOJ of yesteryear, a position no one wants Japan to revisit. So, let's turn to the big pitfall issue facing Japan: long-standing policies of fiscal stimulus and cheap capital from an era that has long since passed. As it stands, Japan currently has a debt larger than most countries have developed economies, that 250% figure I mentioned earlier. If old habits die hard, and debt-financed growth is the chosen method for the elite bureaucrats, then forget about the nice-sounding narrative of normalization exiting stimulus once and for all. You can kiss that goodbye. Yoshikawa might joke that the policies were fitting for the early 2000s. But if Japan continues stalling rate hikes, the result will be borrowing rates so shallow that Japan risks becoming a zombie economy, where interest rates can never be raised without causing a fiscal shock that devastates spending, investments, and, of course, wages. Now, beyond economic models, let's talk reality on the ground for Japan's average worker and its households. We're at risk of stagflation, a scenario where prices rise, but growth stagnates. This is perhaps the most disastrous combination of outcomes from economic policymaking incompetence, and many scratch that, many experts like Yoshikawa see the trajectory landing precisely there. By leaving the cost of borrowing at criminally low levels at a time of mainstream inflation, yes. Flour prices are up 14.1%, dairy costs upwards of 26.7% as of November data. The central bank is risking the very working-class citizens it claims to defend. Inflation with minimal wage increases. The economy either hums or grinds to fragments when you add stagnating salaries. Does that sound like a win? Hardly. Folks, and this isn't a joke. While other countries have taken decisive steps to manage their inflationary problems by raising rates timely, Japan appears to be adrift. Yoshikawa bluntly calls it out, they're behind the curve. So here we sit, watching markets speculate when exactly Japan will turn the corner. And here's the kicker, delaying a rate hike simply for fear of short-term market volatility is a dangerous game. The time to act, according to Yoshikawa, isn't just now, it was yesterday.